Let's start talking about changes in estimates and corrections of errors, things that occur that we realize we need to fix prior years for. Now, when we do that, there's a few ways we can handle it. Really, three approaches. There's the retrospective, which means we have to go back and physically restate prior year's information that we're reporting. Then there's the modified retrospective, which means we do have to do the adjusting entry, but we do not go back and restate the numbers. There's limited application for the modified. Typically what we're talking about is, for example, when the FASB comes out with a new standard. Sometimes they'll say it's retrospective, sometimes they'll say it's modified retrospective, and then other times they say it's prospective. So retrospective means we have to go back and restate all prior years. Modified retrospective means we need to update the numbers by adjusting the retained earnings and whatever other accounts are off, but we do not physically go back and restate the financial statements for prior years. And then prospective means we do not adjust any balances from the prior year. We simply start this year and we move forward with that new information. Now, make sure you've reviewed, because there's several different instances what we're doing there. This is from McGraw-Hill. So we've got change in a principal, we've got change in estimates, and we've got a change in reporting entity and errors. Those are typically the floor classifications of items that create prior period adjustments, so to speak. So when we go to do a change in accounting principle, does that require us to restate prior years? Absolutely. It's retrospective. We have to go back and restate the prior years as report. Now, there are a few exceptions to that. For example, one exception would be a change in depreciation method. If we change from one GAAP-based depreciation method, say straight line, to another method like units of activity, when we do that, we actually handle that as a change in estimate. So that's one change in principle that we do not handle prospectively. We treat it as a change in estimate. The other is an example when items create such a difficult job to actually recreate the numbers. So for example, if we go from a LIFO inventory system to a FIFO, it's very difficult to go back retrospectively and figure out the impact that that change would have in prior years. So since it is very difficult, it creates a great burden on the company to try and figure that out. Things of that nature would be handled as an exception. So it would be handled like a prospective view, okay? So there are a few exceptions to the rule, but most of the time when we change accounting principles, we do have to retrospectively. It means we have to restate. Of course, anytime we have to restate prior years, we have to adjust the numbers in any of the accounts that are incorrect. And then in any case, we have to always disclose. We should pretty much always disclose everything. That's my rule of thumb. Not that we always have to, but when in doubt, disclose it is basically my assumption. So then we've got a change in estimate. And that includes any change in estimates, like in a depreciation, you may just change the salvage value, or you change the useful life in depreciation, or you change depreciation methods. Same with like bad debt expense. If you change the actual percentage, for example, a change in estimate type situation. When we do those, we actually just handle them prospectively. We do not have to restate any prior years. We do not do any correcting type entries to correct last year's balances. We just handle it from today moving forward. A change in reporting entity, of course, we do have to handle retrospectively. Anytime you have a change in entity, for example, you add a company, you have a merger, those types of situations, acquisitions, when you actually go and combine your financials, you can't show this year's financial statements as a combined company and then last year's as a single company. It doesn't work that way. So when we have a change in reporting entity like that, we have to go back and restate the information. We do have to do the adjustments as needed. Now, if we have an error, then yes, we do have to correct prior years anytime we have an error. That could also indicate like error or fraud type situations. We do have to go back and restate for errors. So if we have a change in accounting principle, a change in entity, or an error, we treat it retrospectively. It means we go back in time and restate it. If we have a change in estimate, we simply handle it prospectively. We handle it from today forward. So let's look at this example and see what would we do. First, we have to decide what type of change or correction we're dealing with here. So during 2016, the first year of operations, in 2017, Batali Foods used the FIFO inventory costing method for both financial reporting and tax purposes. At the beginning of 2018, Vitale decided to change to the average method for both financial reporting and tax purposes. The income components before income tax for 2018, 17, and 16 were as follows. So it gives us the information we need. Dividends of 39 million were paid each year. Vitale's fiscal year ends on December 31st. Prepare the journal entry at the beginning of 18 to record the change in accounting principle. So this one sort of tells us, but this would be a change in accounting principle. In other words, we're going from one GAAP method to another, and it is feasibly possible to recreate the information. It's not going to create a burden on us to do so from FIFO to average. That's not an issue. So let's go back. How would we handle a change in accounting principle? Well, when we have a change in accounting principle, besides a couple of exceptions here, we have to handle it retrospectively, which means we have to, one, recreate the prior year's balances in our financials when we report our reports, our financial statements, our annual report. And then we also have to record the journal entry that's going to adjust for that year. So when we talk about corrections of errors, students have a really difficult time with this because you have to stop and think, how am I correcting and what accounts need to be corrected? So let's, in this first example, take just a moment to understand that. And one way I like to do it is look at what happened in our ledger and then what should have happened. I always like to sort of recreate those basic overview journal entries. Now, not that you would see these in the system per se because they'd be more bulk, but this would be just sort of an independent way for me to see how we adjust these accounts. So let's start with 2016 as an example here. Now in 2016, we're going to highlight it in blue. So in 2016, we had 580 in revenues. Well, cost of goods sold will not impact revenue, so we know that account's not impacted. But cost of goods sold, we reported it under FIFO. So remember, in 2016 and 17, we were using FIFO, so we reported 58. Now, what would it be if we were using average? So what we have to do is go back and recalculate cost of goods sold using the average method. So we would have went back, found all of our purchases and all that, and figured out what our average would have been. It would have been 92. And of course, operating expenses of 322 would not have been impacted. Only cost of goods sold on the income statement here would have been impacted. So let's go back in time, 2016, and let's pull up a journal here. In 2016, what did we record for cost of goods sold? Well, remember, when we record cost of goods sold, and I'm going to abbreviate that, we debit cost of goods sold. Well, how much was our cost of goods sold? Well, it was 58. So think about this. This is what actually happened in 2016. Now, what offsets cost of goods sold? Well, remember, anytime we sell a good, we actually reduce inventory. So what makes this chapter difficult is you really have to remember everything that happens in accounting. So it's not like a piece. When we have a change in estimate or a change in, or a correction of an error, we have to go back in time and really think about what happened in this company. Now, what should have happened under the new average cost, okay? What should have happened? Well, we would have, had we been using average cost back in the day, we would have hit cost of goods sold for 92, okay? And we would have hit inventory for 92. So now, in retrospect, what's that difference? So how would we correct that balance? And let's just look at this first year first. How would we correct, let's center that. How would we correct this balance? Well, to correct it, do I need more or less in cost of goods sold? I need more, right? We should have recorded cost of goods sold at 92. We only put in 58. So really, to correct it, I would debit cost of goods sold for 34, and I would credit inventory. Now, this is not our entry. Hold up, because there's some errors in this. I just want you to see what it is. So now, if I went to correct that today in 2018, could I record this entry? Absolutely not. You have to stop and think. Anytime we need to correct a temporary account, that account's already been closed. Remember, at the end of 2016, we closed cost of goods sold out into retained earnings. So when you're talking about a temporary account and you need to correct a temporary account, you actually have to go back and not hit cost of goods sold, because this is actually buried in retained earnings at this point because we closed temporary accounts. Now, permanent accounts we can adjust because they're never closed out. Their balances are what they are at that time. So when we're dealing with a correction or a change that impacts a permanent account, we can hit the actual account, like inventory. If you're dealing with a change or a correction that impacts a temporary account, such as income statement accounts, which are revenues, expenses, gains, or losses, or dividends. Remember, dividends are our other temporary accounts, you must hit retained earnings for that. So that's what we would need to do for 2016 correction. But now remember, we're 2 years out. So now let's look at 2018. What happened in 2018? Excuse me, 17. Because between 2016 and 18, there's 2 years. Well, the same thing, and I'm just going to go and copy this because it's going to be the same concept. Copy and paste. So in 2017, though, we hit it for 60, and we should have hit it for 96. So we actually hit cost of goods sold for 60. We should have hit cost of goods sold for 96. So how are we going to go about correcting 2017? Let me put this would be our new average cost. So what do I need in 2017 to correct this? Well, again, my cost of goods sold way back when, but remember, I can't hit cost of goods sold because it's closed out, so we're going to have to hit retained earnings. Needs to be adjusted, so 36 or 96, excuse me, minus 60 gives us 36. And then where would it go against? Well, my inventory then should increase or decrease, excuse me, by 36. So our cost of goods sold would have been much greater had we used the average cost method. Okay. So when we look at this, these are our two entries that we need to correct those 2 years. Okay. So what would be my final entry? Well, notice both of them are going the same direction. So we needed to increase cost of goods sold. So you take 34 plus 36, and that gives me 70. So I need to adjust my retained earnings by 70 because that will correct it. Because keep in mind, those two numbers are not in the cost of goods sold account. They're actually in our retained earnings account because we had to close them. So just remember, anytime we're going in and adjusting temporary accounts, we can't actually hit the accounts because they were closed out in prior years to retained earnings. So you'll need to adjust retained earnings when you need to fix prior balances on temporary accounts. All right. Now, inventory is a permanent account, so we can adjust our inventory to correct that balance. So we're going to hit it for that 70. So when you're dealing with these, just if you need to, you don't always have to go back in time, but sometimes it helps to go back and say, this is what happened, this is what should have happened, and this is how I fixed that year. I find that a lot of times just to really benefit me when I need to go back and say, hey, this is what they did record, this is what they should have recorded. Now, how do I fix that? In other words, what would be my adjusting entry if I needed one? This is, an updating entry. It's not necessarily, well, it's technically adjusting entry, but what would be the entry we need to actually correct a prior balance? And that's sort of the way I back into it, and it allows me to go forward, and I can do all my years, and then I can make one entry to fix both, and it just helps. All right, now, let's look at the comparative income statements for each year. Because we have to restate, we're going to go in. Now, our revenues were not impacted, so let me split screen here. So our revenues would not have been impacted, so we can still put in for 2018 would be 620, and for 2017 was 590. Now, our cost of goods sold, remember, we are using the average cost now. As of 2018, we need to use average cost, so we need to do 102 for my cost of goods sold. We'll put that in brackets. And for last year, it would be 96. Granted, keep in mind on our annual report, we actually showed 66 for 2017. So this is going to be a different number when we go to do a comparative restate. All right, so then our operating expenses, notice those would not have been impacted. So we can just put the 334 in there and the 330. So what is our bottom line net income for each year? You take 620 minus 102 minus 334, you get 184 in 2018. And then take 590 minus 96 minus 330, and you get 164 in 2017. So that would be our comparative income statements for the 2 years. All right, now determine the balance and retained earnings as of January 2017, as Vitelli reported using FIFO method, and determine the adjustment and balance and retained earnings as of January 17th using the average cost method instead. All right, so what was our balance and retained earnings as of January 1st, 2017? So let's go in and see what we can pull there. So we go back up, And let's look and see what was our retained earning balance. We had revenues of 590. Remember, at that point, we would have had cost of goods sold of 60 and then operating expenses of 330. But then we have to also keep in mind what was our beginning retained earnings. So let's go through and actually calculate what our reported retained earnings was as of January 1st, 2017. So to do this, let's pull up a little sheet here. And let's create what our balance would have been as reported. So let's go all the way back to 2016 because we need to start there. So our beginning retained earnings in 2016 would have been 0. Because the company, let's do this. Because the company began operations in 2016. So if we go back over here, how do I know that? Well, it tells us during 2016, its first year of operation. So if the company just started in 2016, it would not have a prior balance. So we started at 0. Now, remember, to calculate retained earnings, we take beginning retained earnings, we add net income, we subtract any dividends that were paid, and that gives us our ending retained earnings. Okay? So, did we have income or loss that year? Well, let's go back and see. So, in that year, we had 580. Now, remember, we used FIFO, so it'd be 580 minus 58 minus 322. So, the net income for 2016 would have been 200 for our company. Okay? Now, you could create a much nicer form than what I'm doing. It's just sort of a rough draft to get us through this. Now, did we pay out any dividends? Yes, we did. How much in dividends did we pay out? Well, it tells us dividends of $39 million were paid each year. So we go in, we go to dividends, and what do dividends do to retained earnings? Well, it actually reduces our retained earnings. So at the end of 2016, what would our actual retained earnings have been? 161. Now remember, ending retained earnings becomes beginning retained earnings for our company. So what's it asking us for here? It says, what was the retained earnings previously reported using FIFO on January 1st? Well, that would be 161 because the ending retained earnings for 2016 would come in to 2017, sorry. Now, the adjustment to balance for the change in inventory methods. So what balance do we need to do to adjust for a change in inventory methods? Now, keep in mind what we're trying to do here is find the actual adjusted for 2017 beginning, okay? Not the ending, but the beginning. So that means how much do we need to adjust for 2016 to correct the beginning balance, because that's what we're going to need to do our comparative financials. Well, we would have needed 34 because when we look at it, in 2016 our error was 34. Or we can go back here, 2016 our adjustment was 34. So we need a 34 adjustment. Now, is that going to be an increase or a decrease? Well, we would have needed more in expense, so that's going to decrease by 34. So what's that going to give us for our adjusted beginning would have been 127. So when we go to do comparative financials in this view, what we're going to do is actually start with the 127 in 2017 instead of the 161 that was reported before. All right, so hopefully this goes through and explains a little bit about the adjustments when we have those change in principles. Important takeaway here. 1, analyze and find the actual impact. Which direction does it need to go? When using or when adjusting, retrospectively, when adjusting a temporary account, revenues, expenses, gains, losses, or dividends, those type of accounts that are temporary, you cannot hit those accounts because they've already been closed to retained earnings. So you need to adjust the retained earnings accounts when making corrections to prior balances in temporary accounts. Permanent accounts you're allowed to hit because they're permanent. So anytime you have an asset, liability, or other permanent equity account that you need to adjust, then you can actually hit that account because they are still active accounts. So keep that in mind. That's a very important concept to remember. All right. In our next video, we'll look at some more examples of changes in principles and possible errors. Y'all have a great day.